The S&P 500's price to earnings ratio is well over 20 times, which has everyone thinking that right now is a terrible time to invest in stocks. But is that really true? In this video, I'm going to show you a study from JP Morgan Chase, and then I'm going to show you my own study, which expands on that study by about 70 years. I'm also going to add a few additional wrinkles to that, showing you why I think most market pundits are wrong. And then at the end of the video, I'm going to share one investment that I think is better than the S&P 500 right now. In this video, we're going to talk about it. I got a question from Fidel Dali. He says, "Hey Nathan, great work." Thanks, Fidel. "I'm beginning with investing. I know you don't like PE, which is definitely true, but isn't the forward PE and subsequent 5-year annual return on this slide by JP Morgan quite remarkable? You never win starting with a PE over 23 and never lose with a PE below 14. Clearly a bad time to start right now. What do you think?" This is the chart that Fidel is referencing from JPM's Guide to the Markets. They show the forward price to earnings ratio, which for those of you that do not know, that is simply the S&P 500's current price divided by the forward earnings estimates from investment analysts. They're plotting the price to earnings ratio here on the x-axis, and on the y-axis, they're plotting what the future one-year returns were. So when the S&P 500 traded at a forward PE of 21 times, which it is right now, that would be represented by any dot that's on that vertical axis. Anything to the right of that would be a price to earnings ratio higher than 21 times. Anything to the left of that would be a price to earnings ratio of under 21 times. On the y-axis, this is the profit or loss. Anything below this line would be a loss. Anything above it would be a gain over the next 1-year period. And since we're looking at 21 times earnings and above, let's look at the profits to the right of the line. This would be what JP Morgan's data would suggest we could be looking at over the next 12 months. And this is where I think we need to clear up something that Fidel said. He said anything above a 23 times price to earnings ratio, which would be about right here, is always guaranteed to be a loss. And that's not actually true. If you just draw a line here and say the market trades at a PE of 23 times or higher, you can actually see that there were 3 data points that were positive above this profit line and 3 data points below it. So actually it wasn't a 0% chance to make money, as Fidel mentioned. It's actually a 50-50, at least based on the data. They also have the same chart, only instead of looking at just 1-year returns, they're looking at subsequent 5-year annualized returns. So again, let's draw a line on 21 times price to earnings ratio. We are currently at that line, so anything above is what we're looking at. Annualized returns in this particular instance definitely tended to cluster below the 0% line, meaning that over the next 5 years, in a lot of the instances they recorded, the future returns were negative. So does that mean that we should go out and sell our stocks because we're not going to make any money over the next 5 years? Well, not so fast. You see, there's one little note in the footnotes that I think is important for you to see. And the key item I want to point out is that this is beginning 6/30 of 1999. So while this does include 24 years worth of market data, it's also important to remember that you had several bad markets, particularly coming from a high valuation level. I would suspect that almost all of these forward PEs that had negative returns were actually during the technology bubble of the late 1990s. So while it is possible that we're currently in another tech bubble, it's also possible that this just isn't enough data to look at. So to fix that problem, I made my own study. Rather than only going from 1999 to 2024 like JP Morgan did, I actually went all the way back to 1928 and I replicated the exact same study that JP Morgan did. Only I flipped the X and Y axis to make this a little easier to see. So now on the y-axis, we have the price to earnings ratio, and this is trailing, not forward. And then on the bottom, the x-axis, we have total returns over the next 5 years. The S&P 500 trades at a trailing price to earnings ratio of about 25 times. So anything above this line suggests the price to earnings ratio was at or above where we're at today. And you can see that this being the 0% return line, you have lots of instances where the market still produced a positive return. There are only 3 instances where the market lost money over 5 years, but the vast majority of cases the market was still positive. But you can also see by this formula here that the R squared is only 1.1%, meaning that only 1.1% of the 5-year returns were predicted by the starting price to earnings ratio. So while it did have a slightly negative effect by starting at a higher PE, it really wasn't that predictive. There was a lot of other factors that drove it, not just PE. I did the exact same thing looking at 10-year returns. Once again, anything above this line would represent trailing price to earnings ratio 25 times or above. And there were only 2 instances where the 10-year returns were negative, even at such an elevated price to earnings ratio. There were 1, 2, 3, 4, 5, 6 periods where the starting price to earnings ratio still led to positive returns. And actually, more than that, this is 2008. Ironically, when the PE was at its absolute highest, the market produced a fantastic return over the next 10 years. You can see that the R squared is better than 1.1, but still only 7.5% of the future 10-year returns is predicted by PE. I took this research a step further and calculated what the average return of each one of these dots would have been at each different price to earnings ratio. Here were the 5-year returns whenever the trailing price to earnings ratio was over 25 times. The S&P 500 produced an average of 38.5%, so still you made a positive rate of return. However, it certainly wasn't as good as it would have been had you invested under 25 times earnings. In those instances, the market returned almost double at 74.4%. So, all else being equal, you'd prefer to buy at a lower price to earnings ratio than a higher one. However, it would be way too extreme to say that you never made money investing at these levels. Still, a 38.5% return over 5 years is still pretty good, and in most cases, this is going to beat bonds. Over a 10-year period, however, the gap gets quite a bit larger. If you invest over 25 times trailing PE, the 10-year returns averaged 60.3%. Whereas if you invest when the PE is under 25, that return went up to a staggering 209.7% return. So is it time to completely stop investing in stocks? I don't think so. You're still earning a 60% on average return over the next decade, which is still going to be better than the 10-year US Treasury, which is expected to earn around 4.1% per year. If you're still worried about starting valuations on the S&P 500, there's one solution to this problem, and that is don't invest in the S&P. This data is from Morningstar, showing us what the forward price to earnings ratio is for the S&P 500, which I've shown here on the left. This is using the SPY ETF, and you can see that the forward PE, just like the JPM guide to the market suggests, is 21.9 times. Keep in mind that's why my data is different. I'm using trailing, which is 25 times. This is using forwards, 21.9. But on the right, we have a different ETF, one that has a significantly lower price to earnings ratio, one that does not have the Magnificent Seven, those stocks trading at 68, 70, 100 times earnings and above, with a significantly higher dividend yield at 4.16% instead of 1.5%, one with much lower price to book, price to sales, price to cash flow, although admittedly a much lower long-term earnings growth forecast at 6.4 compared to 12.3. So what is this on the right? This is none other than the Schwab US Dividend ETF, ticker symbol SCHD. So while I personally prefer to invest in individual stocks, If you're looking to buy an ETF and you're not interested in paying 25 times trailing or over 21 times forward for the S&P 500, you do have alternate options. SCHD has a quality filter, which I really like. It has a significantly higher dividend yield and a much lower price to earnings ratio. However, just keep in mind that the long-term earnings growth and the historical growth rate for these types of stocks is going to be much lower than it is in the S&P 500. That's the trade-off. You are getting a much lower starting valuation. However, the growth rates are much lower to reflect that. I hope that was helpful, Fidel. Don't get too caught up in the starting S&P 500 PE ratio. Even if you bought the S&P 500 here, I think it would make a fine investment going forward. The most important thing you can do as a beginning investor is to just start investing and keep continually investing year after year after year. Even if you bought at the worst possible time, you would still earn a decent rate of return. I'll talk about that in the next video, which is an interesting look at what would happen if you were literally the worst possible investor on the face of the earth. That video is a really fascinating result that I think you're going to enjoy. So check it out using this link right here, or somewhere on the screen. I don't know where it'll be. It'll be somewhere up here. Just click on it and you can see the results from that study. Thanks for watching, and I will see you in the next video.